Joining me now is Daragh Quinn, banks analyst with Nomura, to talk about the Spanish stress test. Daragh, if we can kick off, first of all, what's your take on the Spanish stress test?
I think Spain has published detailed information on the whole Spanish banking system. They've conducted a rigorous stress test on the key issue facing Spanish banks.
Do you think it's deep and hard enough?
It is, yes.
Okay, and how quickly do you think the message is there to allow Spain's banks back into capital markets?
Yes, I think the purpose of the Bank of Spain running such a deep and detailed stress test is to provide enough information to the market so that the market can say, well, look, the Spanish banking system is facing problems. It has a sufficient buffer to deal with those. We can now look at individual banks and decide which of those banks need to strengthen their capital, but generically, we're not uncertain around the strength of the financial system as a whole.
Now, if we look at two of the measures that were used, one was on sovereign debt, an assumption of a write-down of 200 billion there, and on the housing market. Talk to me about those. What's your take on those two aspects of the stress test here?
Well, I think the key for Spain is the stressing of the Spanish loan book. I think generically what we can say about the European-wide stress tests is that potentially some of the sovereign write-down assumptions maybe weren't as aggressive as the market was looking for, but we have more information now to do that work ourselves, and we have the information for each bank and for each country. For Spain, I think a bigger issue is not necessarily the value of their Spanish debt, but rather the value of their Spanish property loans. And there the Bank of Spain has put in, I think, conservative assumptions, so 28% fall in house prices, 60% fall in the value of land. And I think the net result in terms of write-down of the loan book, I think, is a sufficient test in a stress scenario.
Now, when I spoke to Juan Campo, the Deputy Finance Minister, on Friday evening, he seemed very, very strong in that, yes, we've written that, we've made very strong assumptions on the housing market. So you think that there could be worse to come in the housing market and the write-downs?
Well, I think maybe not the same for each bank, and I think that's one of these positive points from the Bank of Spain stress test, is that it shows us the individual exposures, not just of the listed banks where we have a lot of information, also the unlisted sector, so the savings banks. We now can look at them, look at their relative portfolios, look at the risks they're facing, and decide which banks are potentially have a higher risk profile and which ones have a lower risk profile. And it gives us a better idea of who's facing what kind of write-downs. Let's
just talk quickly about the amount of capital that's needed, approximately 2 billion euros. Where's that going to come from? We saw some private equity come in on Friday with Sevilla. Do you think that that's the road for recapitalisation here, or is there an appetite from equity markets? Well,
I think given the change in the Spanish savings bank sector, the level of consolidation we're going to see a number of different approaches from the banks. So Friday was a good example. They've gone to the private markets to raise capital directly. I think once the mergers legally are completed over the next few months, we will see groups of savings banks looking to raise fresh capital in 2011. And for those banks that aren't able to, they can always go back to the FROB or look to merge with some of the private sector banks in Spain.
Do you think there'll be more merger and acquisition in the sector?
Yeah, I think the process of consolidation of the Spanish banking sector has only started. There's been a significant change in the legislation regarding the structure of savings banks. They're now permitted to do different things in terms of tapping the markets, and I think the process of consolidation is only just started.
Okay, Daragh, thank you very much.